The Minority Market. Episode 63. How to apply rules across different market conditions. Many people create rules, but very few know how to apply them correctly when market conditions change. They treat rules as rigid instructions instead of adaptable frameworks. This is where confusion begins. The minority understands that rules are not meant to control the market. They are meant to control behavior. Applying rules across different environments requires awareness, flexibility, and discipline. Markets move through different conditions, trending, sideways, volatile, calm, bullish, bearish. If you apply the same aggressive behavior in every environment, results become inconsistent. The minority adjusts execution style while keeping core principles stable. The rules remain the foundation. The application evolves with context. The first principle is recognizing the environment before acting. Ask yourself, is the market trending strongly? Is it moving sideways with low momentum? Is volatility high? Is fear dominating or optimism rising? This awareness determines how strict, cautious, or selective your actions should be. In strong trending markets, rules focus on patience and holding positions longer. Many people exit too early because of fear. The minority allows winners to develop while protecting downside through trailing risk management. They follow trend rules instead of reacting emotionally to small pullbacks. In sideways or range-bound markets, discipline shifts toward selectivity. Overtrading becomes dangerous. Breakouts often fail. False signals increase. The minority reduces activity, tightens risk control, and waits for clarity. They understand that not every environment rewards frequent participation. During high volatility periods, emotional control becomes the main rule. Rapid price movements create fear and excitement. The minority reduces position sizes, increases caution, and avoids impulsive reactions. They focus on capital preservation rather than aggressive growth. In bearish or uncertain markets, survival rules dominate. Protecting capital becomes more important than chasing opportunity. The minority respects risk limits strictly. They avoid overconfidence and do not assume quick recoveries. This discipline allows them to remain stable when others panic. One mistake beginners make is changing rules emotionally. After losses, they tighten rules excessively. After wins, they loosen discipline. This inconsistency destroys structure. The minority adjusts rules logically, not emotionally. Adjustments are based on data, review, and long-term performance, not short-term feelings. Another important aspect is maintaining core principles. Regardless of market condition, some rules never change. Risk control, position sizing discipline, emotional awareness, and process consistency. These principles protect you in all environments. Adaptation happens around execution style, not foundational discipline. Rules also help reduce decision fatigue. When conditions are unclear, having predefined responses prevents impulsive choices. For example, rules may specify reducing exposure during high uncertainty or waiting for confirmation before entering new positions. This structure creates calmness. Testing rules across conditions is essential. Review past trades and decisions. Identify how your rules performed during different phases. Did you overtrade in sideways markets? Did you exit trends too early? Did you increase risk during volatile periods? This reflection improves rule effectiveness. Another important habit is scenario planning. Before entering the market, imagine possible outcomes. Ask yourself how you will respond if the market becomes volatile, reverses suddenly, or stays flat. Preparing responses in advance reduces emotional reactions later. The minority also understands that no rule works perfectly in all conditions. Losses are unavoidable. What matters is consistency of execution and risk control. Rules exist to reduce damage, not eliminate uncertainty. One powerful mindset shift is seeing rules as protection, not restriction. Many beginners feel restricted by structure. The minority sees rules as freedom. Freedom from emotional decisions. Freedom from chaos. Freedom from repeated mistakes. Over time, Applying rules correctly builds confidence. Not confidence based on winning streaks, but confidence based on self-control. When you trust your process, market fluctuations feel less threatening. Another benefit is emotional stability. Knowing that your behavior is structured reduces stress. You stop reacting impulsively. You start acting deliberately. This emotional balance improves long-term participation. Markets will always change. Conditions will always evolve. The question is not whether rules need adaptation. The question is whether you can adapt without losing discipline. The minority develops this balance through experience and reflection. When you apply rules across different environments correctly, you stop forcing trades and start flowing with conditions. This alignment improves probability and protects mental energy. Remember, rules are not meant to make you perfect. They are meant to make you consistent. Consistency creates stability. Stability creates growth. Growth creates long-term success. As you continue this journey, focus on building rules that adapt without breaking discipline. Learn to recognize conditions. Adjust execution calmly. Protect capital intelligently. When discipline meets adaptability, you begin operating at a higher level. That is where the minority thrives, not by predicting markets, but by controlling behavior across changing environments.